On today's Positively Sloped, Neil and I discuss Chairman Powell's last meeting as the Fed chairman and what to expect over the next couple months as he transitions out of the position. We preview the Mag 7 earnings season, which kicks off this week, and discuss Micron's rise in the stock market before we wrap up with the sell in May and go away theory. Is it real or is it a bust? Okay, let's talk shop. Today is Tuesday, April 28th. Welcome to Positively Sloped. And Neil, we've got maybe one of the biggest market weeks of the quarter on tap for this week with the Fed meeting tomorrow. We've got Jay Powell's last meeting as chairman, unless we don't get a new chairman by June 17th. We had a consumer confidence number come out this morning, PCE later in the week, and then 4 of the 7 Mag 7 companies reporting earnings. So really diving into the depths of the earnings season with some big tech names. It seems like Iran has taken somewhat of a back seat.
I was all prepared to talk about the Strait of Hormuz. So.
It's nice to get a little break. We're at this point where we're negotiating or not negotiating. The strait is effectively closed. There's not any ongoing bombings, and we're kind of just waiting to see what a peace deal may or may not look like. Are you headed out to Pakistan?
I was, but my trip was canceled. then it was back on, but then it's off again. So I'm really just on standby at the moment.
I would have chosen you.
Yeah, I mean, I should be over there, but it's not happening.
Let's start with probably the biggest event of the week, I think, which would be the Fed meeting today and tomorrow. Priced in at over 99% chance of nothing happening in terms of rates. That's been telegraphed for a few weeks as we stay in this kind of economic standoff between a solid growth in the economic standpoint and also persistent inflation, certainly with the Iranian war. So it looks like nothing's going to happen.
I mean, look, in my opinion, nothing's happening unless, Powell wants to give the middle finger to Trump and then there's a race. But obviously zero chance of that happening. So
and that's the biggest part of this meeting coming up here is finally we have Chairman Powell's last meeting as chairman of the Fed. We've been counting this down since Trump has retaken office, and he's been saying he's going to fire Powell, and he's stupid and ignorant and arrogant and dumb and blah, 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 blah. We still don't have Warsh confirmed yet. So we'll see actually when that happens, when we do have a new chairman in place. But do you expect this to be Powell's last meeting, or you think he's still going to be around June 17th?
No, I think, for sure, it'll be. I think it'll be his last meeting as chair. I would have said a couple of weeks ago, I would have said he's sticking around. I still kind of think he will, and I hope he does. Because, the DOJ dropped the case,
right.
but that seemed a little abrupt. If I'm him, I'm thinking like, all right, what do they got up their sleeve? Where else are they going to come at me? And so I think while that case has been dropped, I probably, if I'm him, I'm hanging around a little longer in my term just to make sure there's nothing lurking on the sidelines, so to speak. Plus, I think it'd be great to have him stay on the board.
Yeah, right? I mean, it's not unprecedented. It's not common.
Right, it's not common
of the last few chairmen. I mean, you and I share a certain skepticism of a lot of administration doings, and it seemed like the DOJ case getting dropped right as Warsh hearings needed to pick up in order to be in place on time was a little coincidental, if you will.
Yeah, and right after Trump says, to keep the probe going.
Right.
So it's like it seems a little. I think reality is Warsh probably isn't confirmed if the case stays in place. So it's kind of a do or die, if you will. Yeah,
exactly. And this has been, I'm sure all chairman terms are the most interesting, set of years in given history. But Powell has certainly been through the ringer, been through a roller coaster ride of his 2 presidents over 3 terms. What do you think his legacy is?
So, I mean, I think he's been an effective Fed chair personally.
Ineffective or ineffective?
I think he's been effective. I think he's been a good chair. Is he going to, look, everybody, I think you think about who are the best.
Greenspan.
Yeah. I mean, Volcker probably ranks at the top of the list, although his situation was a little unique, stepping into double-digit inflation. That guy didn't even have to think. They just had to tackle. But I think if you look at Powell, I mean, he's had it all. He's had, maybe not a full-blown financial crisis like we saw in 2008, but he had to deal with COVID.
Yep.
And, obviously we have, COVID was not only a shock, but then the aftermath of that and just trying to deal with the tugs and pulls of inflation versus growth. I know critics will say that he's late. Obviously Trump thinks rates should be lower. So that's why he's being labeled as ineffective from that perspective. But I think, I think he let the data drive it. I think that's the way that I would want to see the Fed run. And I think, rates are where they should be. And I think, is he going to, he's not going to probably be the best. He's not going to go down with his legacy as being the best Fed chair, but I would expect him to be near the top of the list.
Yeah, it's interesting you say, too late, but he's let the data drive it, because that's kind of what the job is. I mean, if you're not supposed to be, but I mean, this is driving monetary policy. You kind of need to be reactive to data that comes in instead of going where the puck is going to be. You kind of have to be where the puck is,
right?
Because you just don't know quarter over quarter what it's going to look like. So you sort of have to be reactive to inflationary prints and to job growth and to unemployment numbers.
And like the numbers, I mean, they're obviously what they target, the inflation and then full employment, but the numbers aren't bad. So it's not like we have 10% inflation that he's failed to address, or that we have, we're in some sort of recession where he's failed to cut rates. I mean, things are holding their own right now, and I think inaction is the right action, and he should get credit for that.
It's funny. We there's like all these targets that a Fed can set, and the 2% inflation target was the sticker brand of coming out of COVID and the 9.1% inflation we had in 2024. We never got to 2%, but we got a soft-ish landing. I mean, we have a strong economic output right now. Jobs look pretty full in the face of lower labor force because of immigration, or I mean, the immigration
smaller
policies.
Workforce,
And so, no, we didn't get to 2%, and we're at 2.5% before the Iranian war. We're up to 3.3%, but he's manufactured a pretty soft landing. I mean, you think of the things he had to go through. Like you said, COVID. Then in 2022, when we were coming out of that, you had Russia invading Ukraine, and that is now a 4-year conflict. You've got Iran. There's multiple happenings in between 2023 and 2026. Like, it's been shock after shock after shock. And yes, it's always been he's too late. But again, I think he's been data dependent. They've been reactive, and you don't see out of control inflation, and you don't see a bad employment picture.
Right. Yeah, and I think that continues. And what's going to be interesting, if Warsh gets confirmed, I don't know that things are going to actually be that different.
Right.
I think, he's got Trump's ear, or Trump's got his ear, and he might push a certain agenda, but it's a committee by design. And so it's like, it's not like he steps in and suddenly rates go down. So I think a lot of this transition is probably being a little overhyped. And I think, Warsh obviously already has some experience on the Fed. Surprisingly, he's probably one of the more qualified people that we've seen this administration put forward. And so I'm not too worried about it. I think the committee will prevail as always, and, things are going to be steady as she goes.
Yeah, I think Elizabeth Warren called him a sock puppet to his face in the confirmation hearings last week. That'll be the interesting part. And I think Powell will be remembered maybe by one word: transitory. They're coining as inflation as transitory coming out of COVID.
Okay, that was probably the miss. But I mean, look,
it was stickier than transitory.
It was, and I mean, it's a little bit of a joke now, but when you think about the circumstances, and when you look at that, that basically the supply shock we saw from COVID, like it made sense to think it was transitory.
Yeah, it takes time to...
And then it's obviously taken a lot longer to abate. And in some cases hasn't abated, especially when you sprinkle in tariffs. There's a lot of things that kind of mess up the situation. But yeah, transitory is going to be a kind of a 4-letter word for a while.
So let's say we get Warsh in on time, and it's May 15th or June, in time for the June 17th Fed meeting, which is really what matters most, is people seeing the new chairman speaking and kind of hearing his take on things. It'll be interesting because, like you said, it is a chair by committee, or it is a committee on purpose. And so it's not like he's going to come in with this agenda that, my appointee wants me, or my appointer wants me to lower rates. So we're going to lower rates. It's not how it's going to work.
Right.
So do you think that the next move is up or down based on our inflation picture and based on who's coming in as the next chair?
Yeah. So, I mean, I think the pendulum swings closer to a rate cut because, I mean, he will have some influence. Obviously, he is the chair.
Yep.
So he'll have his agenda, and that will be the topic.
And you've got 3 other members of the chair that are Trump appointees as well.
Right. So I think that's where, we've got, we're a month and a half out yet, and there's a lot that can happen.
Yeah.
And we can see, war in Iran maybe gets wrapped up get some of that inflation relief, and then that now makes a cut look even more attractive. One of the things that worries me a little bit about Warren is his comments about wanting to be less transparent and not necessarily telegraphing where the Fed's going, and that I don't. I think there's a need for a level of transparency. Maybe we're too transparent now. I don't know, because now you can't. When every time you speak, it's like
the notes.
It kind of pushes things in one direction or the other. So, but I think you have to have some level of transparency. And if he goes kind of quiet and doesn't give a lot of indications, that could be problematic. And get a surprise cut. Maybe people aren't mad about that, but I think just that mode of operation will be unhealthy.
Yeah, we're in this day and age where everything is every word that's spoken, you can read it 10 minutes later. And so, it's the same thing with earnings, where we get an earnings print, the market reacts, but what they really react to on a more long-term basis is the CFO earnings call or the CEO earnings call and the guidance that they provide. Same thing with the Fed meeting, right? We could get no cut, as everybody's known, for a month. What we're really going to care about is their take on the next meeting, right, and their take on the rest of the year.
Right. It's going to be what was the previous statement? What's the current statement? Let's do a word by word comparison.
Exactly. And that could shake consumers. I mean, we had a consumer confidence print this morning. It was at 92.8 on the index, which was up from 92.2 in March, up from February, still at like the lows of COVID though. And people cited, the worry for future state, gas prices obviously eating into household expenses, and just most of the worry and angst was tied to the Iranian war. I mean, we talked a couple weeks ago and you said, when the consumer really capitulates is when you like to get contrarian from a market perspective. So we're not there yet, you'd say.
I don't think so.
You still side with the consumer.
I would. And again, this is a case where it's poor sentiment, but it can stay poor for a while. And I don't, I think it's in line with what's happening in terms of price pressure and what the average consumer is going through. So I see that alignment. I still sit on that side of the table with them. The things would have to get worse for me to feel like that capitulation is happening. So right now, I think we're going to continue to see bad prints. You might see some optimism creep in if we can resolve this thing with Iran. I think that'll be probably not a huge move though, because we wrap up Iran. If we're lucky enough to do that, we'll see some immediate relief on oil prices, but it's going to take some time. And we talked about this before, right? Like gas stations seem to be able to jack up the prices a lot faster than they lower them. And so it's going to take some time. And until the consumer feels it in their pocket and in their bank account, they're going to stay, I think, a little bit pessimistic.
What's the idiom? Rise like a balloon, fall like a feather. What's the rise like? It's not balloon, but
the rise is like a rocket.
Yeah, rise like a rocket, fall like a feather, I think is what it is. What'll also be interesting is whatever the resolution in Iran means. I mean, they've proven to be more resilient than most people think, and so
should not be a surprise.
It shouldn't be a surprise.
This is why we get in trouble every time.
100%.
It should not be a surprise.
We'll see like what the fallout of whatever deal is. I mean, it looks like through negotiations, they're asking for some pretty substantial reparations that could make them almost pretty whole.
Yeah.
I mean, we'll see in terms of nuclear capability, but from an economic standpoint and from a payment standpoint, they're asking pretty substantial reparations.
I mean, why not?
They should.
And I think, I still don't really quite know what our objective with that whole theater is. If it was to really like take away some nuclear capability, which again, we talked about this, like I thought they didn't have it anymore after last June, but apparently still a threat. I think probably one of the worst things that I would think could come out of this. I mean, it's a bad situation all the way around, but they can't control the Strait of Hormuz. And which is an ask, right? They want it to be a toll road now.
Yep.
And I think if that happens, if there's any consolation to that, then this whole thing has been a negative, a greater negative than I think it is right now.
I would agree with that. We'll see how
we snuck in the Strait of Hormuz.
No,
even though it wasn't on topic.
We'll see how it plays out from a Fed standpoint. You expect it to be nothing tomorrow. We'll see if there's any farewell wishes from Powell. But I think the investors are more focused this week on earnings. We get this. We've had unbelievable earnings growth quarter over quarter for much of the last 4 years, coming out of like the COVID, negative and then positive respike. We've got Google, Microsoft, Amazon, and Meta all after hours on Wednesday and Thursday. So the first half or a little over half of the Mag 7, Nvidia obviously always wraps it up. S&P 500, we were talking about this last time and you asked me to come with some more data. So S&P 500 expectations for the quarter were 13% year-over-year growth. As of Friday, we've had 28% of companies report. Obviously, in the S&P 500, obviously those are kind of on the smaller end or financials and not the big tech names. But we've got 81% surprise to the upside so far and a 15% year-over-year growth number. So without the biggest players so far, we're exceeding that expectation. And it looks like we've got 9 of 11 sectors on tap to grow. I think the big turning point will be energy and how the short-term spikes from the Iran war affect those. But, I think we're pacing above 13%.
Yeah. I mean, obviously another strong quarter. I mean, I think, you quoted 81% surprise to the upside. I mean, that's not a surprise.
I've got a comment about that.
Like later, on average, I think it's probably 75% anyway. And it's all guidance, revisions, and then you meet to beat type of thing. So that's not surprising. That's statistics, not crazy. The 13% growth, that's solid. I think, we talked about this last time that the tech push, AI push for sure is going to keep that number high when you aggregate everything. It's not obviously a flat 13% across the board, but yeah, strong quarter. And we'll see where it leads. I guess it's positive.
Yeah. Yeah. I mean, we've got with the 4 coming up this week already. The Mag 7 itself is projected to grow 20% in this quarter for earnings. Revenue growth projected to grow 22%. I think the big picture though, like I said earlier, it's not really earnings, it's guidance. And you mentioned that as well. And there was a little loop thrown into the market last night with OpenAI releasing whatever segment of time their earnings were from. And, they missed on their own internal projections for revenue and users. And given all the deals that they did last year to get intertwined with the Mag 7 and Oracle and all these big software companies, that's dragged the market down today. I mean, the NASDAQ's down 1%. All these names are hit a little bit from OpenAI's numbers last night. But it's the age-old question, and it's especially true with AI right now, but can the profits keep up with the spending? And OpenAI started to show some cracks last night.
I mean,
not if you ask Sam Altman, but
first of all, I mean, profits have to catch up to spending first and then see if they can keep pace. They're not there yet. And, look, if you take a step back, I think it's a pretty fair statement to say that right now the whole AI thing is still circular. It's just infrastructure build out. It's like, I'm going to buy your GPUs and, we're going to have a software contract. So the user growth hasn't happened yet, and it takes time. So I think I'm still bullish on it. I think we'll get there eventually, but until that happens, I don't see profits keeping up with the spend. And so you're still kind of betting on that outcome of at some point there's going to be a large scale adoption of the technology. And I think you see surveys, like I think a lot of companies are still struggling to figure out how to use it in their business models. Like what processes are they going to try to replace? What are they going to move to more of an agentic model and try to reap some of the productivity benefits that are being touted with this technology. So until that happens, we're going to see, I think, profits lag.
Yeah, I think the other interesting thing is the kind of dynamic shift of the last few months between OpenAI and Anthropic, where ChatGPT was kind of all you heard from a chatbot perspective and LLMs, and then all of a sudden we hear that Claude was used in Venezuela, and now there's this constraint for both ChatGPT and Claude on processing power and data, and there's some limitations on how many users they can take on. It sounds like we're kicking around an enterprise relationship for the firm, and sounds like you got to get deep in line for Claude right now, and you got to be in the 6-figure spend. So I think Anthropic has certainly eaten into OpenAI's market share a ton, and probably. I
mean, anecdotally, too, I don't know if I'm sure you've probably played around with both ChatGPT and Claude.
Yeah,
and I mean, like the anecdotal feedback I get is people prefer Claude.
Yeah.
And I've done some side-by-sides where I've asked, obviously done same query in subject matters that, I consider myself knowledgeable in. And, you definitely get very different responses. And I'm a paying subscriber for ChatGPT, but I'm using Claude for free because, it just seems to be a little more useful responses.
Yeah, I'm in the same boat. I pay for, I don't know which ChatGPT plus version of it, But I think what you get from a chatbot perspective is ChatGPT wants to be your friend. And wants to kind of quote answers when you're in the wrong.
Right.
It's very confirmation biasy. So a lot of the times when I'm prompting, I'll say, don't automatically agree with me.
Right.
Claude is pretty much to the point. Like, this is your answer. And then I think from an LLM perspective and learning, and Claude seems to be superior from people I've talked to that are actually trying to train models. And so we'll see what the advancement of that looks like. I mean, Sam Altman is the personality more so than Dario, I would say. And OpenAI has been, they linked to everybody in the tech industry last year, kind of ahead of their time a little bit. And their deals with Oracle for cloud computing, like, we'll see if they can keep up. It seems like Altman's philosophy is kind of what you said, that more spending is going to then derive more profits, and then it's going to snowball. It's kind of a chicken and egg situation, I think.
For sure.
There's a lot of worry about from the CFO and from other C-suite members of OpenAI if their spend is worth it and if we're going to see profits soon enough.
Right. Yeah, I think it is. It's moving now from that, like, hey, this is this cool technology. It's now the clock is ticking now. And I think investors are going to want to start to see some return on these massive CapEx spends. And they're going to, at some point, the investor base will get impatient. And what typically happens is they get impatient probably prematurely because they don't, everybody wants that short-term satisfaction. And so I think there's going to be some headwinds eventually. We'll go through a period of that, and then on the other side of that, maybe see what sticks.
Yeah. And I mean, we'll see if OpenAI as a private company, again, they less transparency for sure. We'll see if that forebodes what comes with the rest of earnings season. But so far, mentioned strong earnings thus far through the first couple weeks. What's been interesting though is guidance. Guidance has been very mixed of firms that have offered their guidance for the following quarter. It's about 50-50 on positive and negative guidance. And that is, again, we talked about this last time. A year ago, the keyword was tariff. Now it is energy prices and Iran.
I mean, look, every time they give guidance on the next quarter, it's a giant hedge. And so you're going to see that now. And then, the great thing is whatever they say today doesn't really matter, because as we get closer
to zero accountability.
Right, and as we get closer to the next earnings season, they'll be revised based on, additional information that's been gathered. So it's funny. The market likes to react to that guidance. And so that's where you pick up a lot of the short-term volatility around earnings season. But in reality, I like, it's noise to me, really, at this point.
Yeah. There's one company in specific I wanted to talk about, and it's not related to necessarily this earnings season because they reported in mid-March, but Micron. Just on an incredible run, up 560% year over year, up 84% year to date. Is
that a lot?
That's decent return.
Right, okay.
As we transition into this, memory, data and memory being obviously at the forefront of what we need to store for CPUs and GPUs.
It seems a little, doesn't it seem a little obviously it's kind of, when you talk about, obviously Micron's business is memory chips, and there aren't a lot of chip providers in the memory space, maybe 3, 4.
It's a pretty much duopoly between them and SanDisk.
Yeah. And Samsung has, I think,
a little bit
play in there too, but so it's like, why? This seems like it came out of nowhere. It's like somebody woke up one morning and said, holy cow, we've got all these GPUs, but we need memory.
Right.
And so now, you get that spike, but is it really one of, memory is historically a commodity. So it's like you're at the whims of whatever the compute cycle might be. And so everybody, you don't see like these big earnings spikes or rises in stock price because people just assume it's going to be cyclical. I think what's possibly happening here, and I don't know if this is true, but if they're now being viewed as an AI player because they're going to be a major provider of the memory chips, which AI needs, then you've got a little bit of a paradigm shift. Well, you have a paradigm shift. I don't know what a little paradigm shift is, but you have a paradigm shift. Now they're going to be viewed as an AI player. They're going to be revalued as not being cyclical, and we'll see. I wish I would have bought Micron stock a year ago.
It's really interesting because I think the market aligns with that thought process that you just laid out, because it's up 560% year over year. That's great. It's still only trading 9 times forward earnings.
Yeah.
We're at a stock price of about 550. It looks like there's going to be fiscal year earnings per share of $57. And so it seems like the market is still treating this as cyclical. The broader base market, yeah, there's unbelievable price action, but there's not this big flow of money that's going to drive the stock even up even further, and kind of regulate that forward PE ratio towards the broader market of like 21 times. Maybe because the market views it as cyclical, and the market doesn't view this as a long-standing solution.
Yeah, I mean, for sure. Solution. Like, I don't even know where it's sitting at forward PE right now. Multiple, probably
what?
9, 10.
Micron,
9x forward earnings. So, so it's like, but I think it's early for that. So, I wouldn't be surprised if that went higher. But it's going to, a lot of it, like, again, it goes back to this giant circular market right now in AI and all the CapEx and all the build out, like, if that, like, it hinges on that, getting past that and seeing the AI piece stick. And so I think it probably will linger in that, 9, 10x for a while, but I wouldn't be surprised if it went up from there.
Yeah, and back to something that you and I talked about at a client event in October up in Rhode Island, and it was your kind of your floor. But where would you want to be in the AI play right now? Do you want to be in the picks and shovels? Do you want to be in memory? Do you want to be in data processing, infrastructure, software? Obviously, software has taken a huge hit over the last few months. So would you rather be Micron or Nvidia right now? Would you rather own Micron or Nvidia?
Yeah, I mean, I would own them both. I think I like
that's not an option in this.
It's not an option right now.
They're mutually exclusive.
Then I'm probably sticking with Nvidia, because I think, again, it's probably, I don't know, I haven't studied like Micron's inventory levels, but I know it's very easy to get into an oversupply in memory, probably more so than GPUs. And so I think that if something's going to be cyclical, you have a greater chance on that memory side. So I would stick with Nvidia. But I'll tell you Nvidia, but then when I go back to my account, I'm buying both. Like because I think, and that's the play right now. There's too much uncertainty, I think, still in what is that software play, where in some ways it all has to work. Like we have to get a business case for AI in order to support that technology, and then make all of that CapEx spends be worth something. So, if those things don't happen, the whole thing's a house of cards and falls. But for now, I'd still be playing in the hardware side.
I tend to agree with you. I think Nvidia, like I said, from a Micron perspective, there's 2.5 players. Sure, I'll give you Samsung in the memory space. I like the comment, whether it was tongue in cheek or not, that this seems like it came out of nowhere, because it's like a 1-year rise in both these names. And if you weren't really tapped into the AI space, which I certainly cannot claim to have been multiple years ago, the Micron's a new name for you. SanDisk is a relatively new name for you. Samsung's not, because of the phones. But Nvidia has had players try to come up and eat into market share. You got Intel, you got AMD. We know Google's in the process of making their own chips. Meta's probably going to get there as well. Like, everybody's joining the space, but it seems like Nvidia has such a competitive edge because they've been doing this for, I don't know, 15 years at this point. I mean, Nvidia GPUs have basically powered OpenAI's rise for the last 10 years. And that's why they got that $300 billion deal with OpenAI. I like Nvidia's spot as a market leader, and its ability to fend off competitors more than I think I like Micron's.
I mean, I think in the memory, like if you were just looking at who to own in the memory space, I mean, Micron's a great bet. Like, I mean, it's actually, for a U.S. investor, certainly the easiest investment to make. And probably the best. Yeah, I mean, there's probably some investor anxiety around buying something that's $600 a share that's gone up 560%.
Yeah, this is the weird part, right? Like, we talk.
I mean, that's the investor psychology coming in, and but you would have been saying that when it was up 100%,
no doubt,
right? And now it's up 500%, and so it's one of these things where you just can't. You got to build the business case, you got to build the investment case for it, and then and then follow that plan and stick it out.
And if you're a fundamental investor, one of the core things you look at is it's trading 22 times today's PE. It's trading 9 times forward PE. You would say that stock's going to go up to match that, forward PE. So there's still appreciation left if you like the fundamentals. Now, if you like the technicals, we're approaching May 1st here. By the time this comes out, we'll be 2 days away. Do you buy into the sell in May and go away theory? As a seasoned investor that likes to stay invested.
Well, I'm a big fan for calling out spurious correlation. And so I think
not Steve Spurrier's correlation.
Not Steve Spurrier's correlation, but spurious correlation. And to me, that's what that's the kind of May to September doldrums that we see occasionally. I think it's spurious. I think, the funny part is everybody will try to come up with a case for why it should be, people go on vacation and markets are just less attentive and, so got minds on other things. And then everybody comes out and goes to school and then things kick off again. Right. That's not how it works. I mean, people are in the markets always. Yep. I think it's fun. It's like this, the old, how's it go? Like if the NFC wins the Super Bowl and the stock market's up for the year, I'm betting here. If you looked at it, I'm going to, I don't know this, but I'm betting you look at NFC, sell in May and go away is a good thing. And then AFC wins the Super Bowl, then you don't. And now we're spurious correlation on top of spurious correlation. So I'm not a big believer in it. I think it's not something folks on.
It's like a lot of technical trends, if you will, that if you want to find confirmation bias, you can find it.
Yes.
And if you want to say that sell and May go away works, you can find the data for it. I mean, over the last 25 years, May to October is like 2 to 3% return, and November to April is then 6 to 7% return. Is the only interesting thing about that is July typically tends to be the best month of the year for the S&P. And so it's odd that would be in the middle of kind of the lower return and summer and lower volumes. The anti thesis to that would be, or the antithesis to that would be, 5 of the last 6 years, May to October, has been up in the market pretty substantially.
Right.
And so again, I think it's something that if you look for, if you want to find the yes or you want to find the no in a trend, you can find it. My question is, what's your alternative? You're going to go sit in cash? Right. Like if you're getting 2 to 3% from May to October and you want to go to a money market that pays 4% annually and basically get 2% from May to October, are you going to be in a better psychology if the market goes up and you trusted the trend and said, well, I had to go to cash, right, and you got outperformed, or if the market gets 2% and you get 2%? I'd rather ride the ride.
Yeah, for sure. I mean, I think you ride it out, you wait. And there's a weird, a lot of that again comes back to investor psychology as well. I think, humans, that we value gains differently than we value losses. And so I think you're going to have regret if you're on the sidelines and there's a huge rally.
Yep.
And for sure you'll feel bad if the market goes down and you're in it, but everybody's in it at that point. So we're in the misery loves company stage
for sure.
Of the psychology. So I don't think it's smart. I think you just ride it out.
And the way that you've built a couple of our portfolios at Kingsview is staying invested, and the philosophy behind missing the best days in the market. And we tend to see the best days come after some of the worst days. And if we drop 2%, there's a reasonable expectation that we might get back 1.5% the next day.
Sure.
And if you capitulate on a bad down day, you're likely to miss the next good day. One of my favorite stats is that if you miss just the best 5 days, total 5 days of the last 25 years in the market, your growth of $10,000 drops from 63,331 to 39,120. Basically,
right,
you're out 200% or so on that.
Yeah. I mean, obviously, if we could strategically miss the best days, then we could strategically miss the worst days, right, and we can flip the tables around and make that work in our favor. I think you're right. The big days and the big up days, big down days tend to cluster.
Yep.
It's usually a reflection of the market environment we're in. We're in some high volatility environment that's being event driven or some crisis events happening. I think so. In a lot of what you talk about, like when you look at just the math of returns and the fact that they're asymmetrical, you can very easily build a case where missing losses can be a huge benefit to your portfolio, and that's it's credible math. Then the task becomes, can you miss the losses? And when you miss, like if you flip that around and look like what that $10,000 investment looked like if you missed the 5 worst days, it's going to be a very nice surprising number to the upside. The problem is trying to get that timing down. We actually do have some tactical strategies that they don't look to try to miss that, worst day. Like they're not focused on such a short time frame. I think there is some logic behind looking at market cycles and knowing that, if you're in a bear market that's forming, that there's a likelihood that bear market is going to be sustained, taking some risk off the table can work in your favor there, but trying to pinpoint days is impossible.
Yeah, I think especially for someone approaching retirement or in retirement, that sequence of return risk and protecting that is probably, like you said, there's credible math behind missing bad days being almost as good for you, if not better, than having slight upside days. I think back to the tariff tantrum last year. You could have missed April 9th and missed the back-to-back down 2.5%, 3% days. But if you weren't back in on Monday and getting that 3%, 3%, 2%,
right,
you were even, if not behind already.
Right.
And so it works so quick like that. Obviously, that feeds into a trend of ours that we like to talk about with speed of information. That, again, I've said this many times on the pod, but I remember the tariff tantrum day. We were sitting in the conference room having an investment committee meeting, and we were like, holy, like the market's down 3%. And then 28 minutes later, we were like, the market's up 1.5%. Like, we had a tweet that wasn't a tweet, that was a tweet, that wasn't a tweet.
Right.
And like,
yeah.
we're in the day and age where that can happen right now. But certainly, I think what's important is you stay invested, you stay true to your philosophy. If you're in a tactical strategy, that's great. It's okay to
let it do its thing.
Let it do its thing. And you trusted the philosophy and the criteria behind why we're making moves and why you're coming back in or going out. And inevitably with those strategies, you're going to miss bad days and you're going to miss good days, and you're going to be in for good days. You're going to be in for bad days.
Right.
But you got to find something that works for you, that kind of eases the psychology piece of it.
Yeah. I think the biggest thing is, like, if you don't have a plan and you go into these crisis moments, the decision making is so emotionally driven that it doesn't lead to anything positive. It's like, you can't be reactive to those kind of events when they're happening, because that's when you'll make the worst decisions. You will capitulate on a down 2% day. And then as humans, we're wired. And I've said this a million times, and then you're going to sit on the sidelines until it becomes obvious that you should have gotten back in, but then it's too late. Like, you've already should have been in. And so, and that's not our fault. That's just human psychology, human behavior. So best thing to do is sit on your hands and not make any rash decisions in that heat of the moment.
Yeah, I'm completely aligned with you there. Let's wrap up with our fades or trades for the week. I mean, we've kind of discussed a little bit of these, but we'll get some succinct takes on this. Speaking of sitting on their hands and the Fed, would you fade or trade that Powell is out of the Fed on May 15th?
I'm going to fade that. I think he sticks around.
Yeah, I'm going to fade it. I had it as a trick question because I think he will be. I think Warsh will be in as chairman, but I do think Powell, even if he's not sticking around through 2028, I think he'll stick around for a short period of time.
I think it's just too soon
keep
with
his
that,
influence in there.
with the DOJ dropping his case. That he's going to want to, because I think part of the strategy is to stay on. Like, if he's suddenly in the sidelines, he's forgotten about, and then it's much easier to do whatever if you're trying to implicate him on something. Whereas if he's visible, then you can let that
little defense.
That's my read, I would say, or that's what I'd be doing.
I like that. Second fader trade for the week. S&P 500 earnings growth tops 15% when it's all said and done at the end of the.
All right, you sold me. I will. I'll trade that.
Okay. I'm going to trade it as well. Right now, we've got 9 of 11 sectors projecting earnings growth. Like I said, the wild card will be energy. And we'll see what kind of short-term swings. I mean, that could, if you've got energy companies that are reporting huge earnings because of February and March, because of the Iranian war, you're going to see a big print. I think if those kind of fall through, it could.
And the odd part is we'll see how those impact. Obviously, it's supply, like the price of oil has gone up.
Yeah.
But if you're not selling it,
you
got a nice asset on your books, but where are the earnings?
That's fair. That's fair. Third fader trade for the week, and this is, I said I had a point on this earlier, but a United and American Airlines merger is a good idea. Do you fade or trade that?
I'm interested
in your commentary.
I'm fading. I don't want American to be dragged down.
That's what it is?
Yeah.
Okay. I'm going to fade it as well. I think if they merged, United would get some good espresso machines
in
their club lounges,
broken.
But they'd basically be picking up a bailout. American down, what, 40,
I think just
40% in the last 5 years?
That's just the stock price. I think more seriously, just the pure antitrust, what that would mean from a competition or anti-competition standpoint, it just seems like it would be hard to get through.
Yeah, and I think inevitably would be negative for consumers. Like I would like, as a Chicago hub guy, like that's really why I fly United most, is because Chicago, Denver, and a couple other stops, Newark. If you connected American and I could get to the Southeast easily, or I could get to Phoenix easily, like that route tree grows. But I think inevitably this is American capitalism. And if you've got a company that owns 40% of the skies, they are going to raise prices because they know they can, and they're going to go up. They're going to squeeze every penny out of customers, whether that be on ticket prices, on luggage fees, upgrades, whatever. I think it'd be great for loyalty programs, because I think I fly United as much as I can, but if I have to fly American, I will, and it goes off my books on United, which sucks. But I think inevitably it'd be a negative for consumers.
Yeah, I agree.
Last fader trade for the year, kind of a random poll here, but Intel is up 130% this year, coming off of strong earnings. They've really rebounded the company since last year, let's say. Do you fade or trade the Intel rise?
Man, so what's the bet? Like, through the end of the year, is it going to be higher or lower from where it is right now?
Yeah.
I would trade that. I mean, I'm not talking about is it going to double from here? No, but will it finish higher from here? I think marginally, yeah.
Do you trade their role in the AI space?
So I do. I mean, look, Intel's gone through a transformation, and the new CEO is doing a bang up job. I'm bullish on him. I mean, it's hard to. It's now. I mean, we talk about the psychology element of investing. Like, it's hard to buy a stock when it just jumped 20% on earnings. But I think I do think they're legit turnaround in general, and then are a real AI player. So yeah, I think I'd trade that.
Yeah, I'll trade them as well. I mean, they seem to be in a better spot to be part of, part of this grouping, and I think there's a jolt added to the company and to surrounding companies that are doing deals with Intel when the U.S. Government took a 10% stake last August, and Intel saw some quick deals go through with other companies after that, and so I think there's been a revival. Again, I like what you said, that they've kind of had a transformation of what they are, and I would trade them as well. I'm bullish on them as well in the short term and long term.
Yep, agreed. We didn't disagree on anything.
I don't think we did disagree on anything, which kind of defeats the purpose of this. So we may have to.
All right, we're gonna have to come up with some more controversial topics, I guess.
I mean, I'm fading the hell out of the Pistons,
dude.
I think you might be.
Oh my gosh.
I think we might be aligned on that too.
I mean, like, that's gonna be a tragic, freaking best record to first round dropouts. I mean, look, there's still hope, but the light is dimming.
It's a bad matchup. The Magic are physical.
They are. Their defense is crushing the Pistons right now. They had like 20 turnovers in the last game or something.
Yeah.
The NBA for me is hard to watch.
Michigan on a bad night.
I mean, but Michigan still wins.
Yeah, I know.
So that's the piece that's missing in this puzzle.
The NBA tough product right now, just a lot of foul baiting, and like I said to you, it looks a little better right now. You've got like 192 games instead of like 140 to 130, which I think is better. I don't want to see guys taking open shots and having open run at the rim, but still, you watch a game and you get these like 20-second possessions that's just dribble, and then pump fake and then draw a foul, and it's like, what am I watching? I think it'll get better as the playoffs go on and we get down to the final 4 or final 8 or so. I think we're on a Thunder Celtics collision course, but I don't watch a ton of it, which is rare.
If the Pistons are out, I'm done. I probably won't watch anymore.
Yeah, fair enough. Well, we're done for today.
All right, perfect.
So that's today's show, and we'll be back next week.